Dear students, myself Professor Vikrant Palatsha welcome you all in my YouTube channel Professor Vikrant Palatsha Education Hub. In today's video, we are going to solve some more problem related to the income from house property. So in that the first problem that we are going to solve, that was a problem asked in the Savitribai Phule Pune University October 2022 question paper. So this is the problem there. Compute income from house property of Mr. Sharma for the assessment year 2025-26 from the following particulars. So in that municipal value is given 90,000, fair rent 92,500, standard rent is given there 87,500, annual rent is 84,000, unrealized rent 21,000, vacancy period 1 month, municipal taxes are there 15%, and the interest on loan is given there 17,500. So from this given information, now we are going to compute the income from house property of Mr. Sharma. So for that, first of all, give the heading in computation of income from house property of Mr. Sharma for the assessment year 2025-26. So dear students, first of all, now we are going to find out there the gross annual value. Okay. So calculation of the gross annual value, first of all, we have to find out the reasonable expected rent, and for that we have to compare the municipal value and fair rent, and from that we have to find out whichever is higher there. So in the problem, municipal value is given there 90,000 and the fair rent is given there 92,500. So highest from the 90,000 and 92,500, we get the highest value 92,500. Clear? Then in the second step, we have to compare this highest value 92,500 with the standard rate and find out the minimum of the both. If you check in the problem, the standard rate is given there 87,500. Therefore, we have to compute the reasonable expected rent, and for that what we have to do, minimum of step 1 and standard rent. We have to find out the minimum of the value of step 1 and value of the standard rent. So value of the step 1 we get 92,500 and standard rate is given in the problem 87,500. So minimum of these two is our reasonable expected rate. And how much the minimum value we find out there, we get there 87,500. That is the reasonable expected rate. So here we get the reasonable expected rate 87,000. Okay, now in the next step we have to find out the actual rate. How to find out the actual rate? Actual rate is equal to annual rate minus unrealized rate. So if you check, the annual rate given in the problem is 84,000 and unrealized rate given in the problem 21,000. Put both the value there. So annual rate 84,000 minus unrealized rate 21,000, we get there the actual rate 63,000. Okay, so now we have the reasonable expected rate as well as the actual rate. And now from this we have to compute the gross annual value. How to calculate the gross annual value? Maximum of reasonable expected rate and actual rate minus loss due to vacancy. So maximum of reasonable expected rate and actual rate. How much the reasonable expected rate we get? 87,500. How much the actual rate we get? 63,000. So which one is the maximum? Which one is the highest from these two? Definitely it is the 87,500. So from the 87,500 we have to minus the loss due to vacancy. And how to calculate the loss due to vacancy there? Very simple. Annual rate divided by 12 months multiplied by the vacancy period 1 month. So annual rate that is given in the problem, it is 84,000 there, and the vacancy period is given in the problem 1 month. So 84,000 divided by 12 multiplied by 1, we get there 7,000. So the maximum of the RER and actual rate is the 87,500 minus loss due to vacancy 7,000, and therefore we get the gross annual value here. How much? 80,500. Understood? So in this way we get the gross annual value 80,500. Put that in the problem. So gross annual value As per the working note number 1, we get the 80,500. Once we get the gross annual value, from that we have to deduct the municipal taxes paid. So municipal taxes paid given in the problem how much? 15%. So direct amount is not given, percentage is given 15%. So 15% of what? 15% of the municipal value. Municipal taxes are always paid on what? Municipal value. So you have to calculate 15% of municipal value, that is 90,000, and that is the municipal taxes. So therefore 15% of 90,000 the municipal taxes, here we get how much? 13,500. So therefore the municipal taxes paid amount we get here 13,500. Deduct that amount from the gross annual value. Our gross annual value is 80,500 minus 13,500. So there we get the net annual value how much? 67,000. So therefore the 67,000 we get the net. Understood? Once we get the net annual value, from that we have to deduct the deductions under section 24. So therefore under this deduction, the first deduction is always what? Standard deduction, and that is 30% of net annual value, means 30% of 67,000. So we got the standard deduction here how much? 20,100. Okay, understood? This is the first, and second deduction is what? That is the interest on loan that is given in the problem. How much is the interest on loan given in the problem? That is 17,500. And what is the rule for the interest on loan deduction for let out house property? Maximum amount will be 2 lakhs. So it is already below than the 2 lakhs, so whole amount is deductible as interest on loan, and that comes to rupees 17,500. So therefore in this way we get the income from house property. It is how much? 29,400 after deducting the deductions of rupees 37,600 from the net annual value. Then we arrive at the final answer, that is the income from house property 29,400. So therefore, dear student, it is the solution of the problem that was asked in the October 2022 question paper. Okay. After this, now next problem we are going to solve, and that is the problem asked in the recently conducted examination of the Savitri by Phule Pune University, and it is the problem of October 2024 question paper. So what is given then? From the following information, compute the income from house property of Mr. Ravindra for the assessment year 2025-26 from old tax regime. So the given information is that municipal value 3,60,000, fair rent 3,70,000, annual rent 4,80,000, municipal taxes paid 36,000, amount spent on repairs 36,000, and interest on capital borrowed, means interest on loan, is 1,80,000. Okay, so from this given information, dear students, we are going to solve this problem. In this problems, one new information you find here. What is that? Amount spent on repairs 36,000. So suppose amount spent on repairs is given, amount spent on renewal is given, any kind of ground rent is given. Ignore all these amounts. These amounts are not useful for the calculation. So any amount of repairs, any amount of renewal, any amount related to the ground road rent, whatever is given, just ignore it. It is not useful for the calculation. Clear? Understood? Now we are going to solve this problem. So first of all, give the heading there, computation of income from house property of Mr. Ravindra. And for that, now we are going to calculate the gross annual value. Now directly we are calculating the gross annual value. We are not going to prepare the working note now. Okay, how to find out the gross annual value? First of all, compare the municipal value and fair rate and find out the highest one. So here municipal value is how much? 3,60,000. And how much is the fair rent? 3,70,000. So which one is highest from these two? Definitely 3,70,000. That is the highest rent. Now compare it with the standard rent. No amount of standard rent is given, so standard rent is 0. Nothing amount. It is not applicable. Sorry, it is not 0. It is not applicable. So therefore, standard rent is not given. So don't compare. So directly put up the highest value as a reasonable expected rent. So reasonable expected rent here we get how much? 3,70,000. Clear? Understood? Now compare it with the actual rent minus unrealized rent. Actual rent is equal to how much? Annual rent minus unrealized rent. Annual rent is given how much? 4,80,000. Unrealized rent is not applicable. Therefore, how much is the actual rent? 4,80,000. So we got the reasonable expected rent 3,70,000. We got the actual rent 4,80,000. Compare both amount and find out the highest one. Reasonable expected rent 3,70,000. Actual rent 4,80,000. Which one is the highest one? That is the annual rent 4,80,000. So 4,80,000 is the highest value. From that deduct loss due to vacancy. So no loss due to vacancy is given. Loss due to vacancy is 0. Therefore, our gross annual value we get here how much? 4,80,000. So in this way, dear student, we get the gross annual value how much? 4,80,000. Just put in the problem. So gross annual value we get here directly 4,81,000. Once you get the gross annual value, from that deduct the municipal tax paid. And municipal tax paid amount is given here. How much is that? 36,000. Deduct that amount from the gross annual value. Municipal tax paid how much? 36,000, and therefore the net annual value we get here how much? 4,44,000. Clear? Understood? So here the net annual value we get 4,44,000. Okay, understood? And therefore now less deductions under section 24. Okay, from the net annual value. First deduction is always how much? That is the standard deduction, and standard deduction is how much? That is 30% of the net annual value. And how much is our net annual value we get here? That is 4,44,000. So therefore 30% of the net annual value 4,44,000 we get. The standard deduction amount here how much? 1,33,000. That is the amount of the standard deduction. And the second deduction here we have to deduct. What is that? That is the interest on loan. That is the interest on capital borrowed. How much is that? It is 1,80,000. And what is the rule regarding the let out house property for this deduction? The maximum amount will be 2 lakhs. Here it is already less than the maximum amount. So therefore the deductible amount is the whole amount of rupees 1,80,000. That is the interest on loan, and therefore the total deduction that comes to rupees how much? 3,13,200. So deduct that one from the net annual value of 4,44,000 minus 3,13,200. Here the income from house property we get is how much for Mr. Ravindra for the assessment year 2025-26, 1,30,000. Understood? So in this way, you have to solve the problem related to income from house property. I hope all these two problems you understood very well. For the videos like these, I request you kindly subscribe my YouTube channel, Professor Vikrant Palat Shah's Education Hub. Like this video and share with your friends.